Welcome, everyone. This is Eric Jordan, Canadian Personal Property Appraiser, CPPA, and former auctioneer specializing in intangible assets. Today, we're going to talk about something that might just change the way you think about business valuation and who is truly qualified to do it. If you've ever wondered why someone with 10 years of experience owning and operating a COBS Bread Bakery or a similar business is better equipped to value a business than an accountant with 20 years of experience, you're in the right place. Stick with me, because this will be an eye-opener. On my website, pin.ca, you'll find a wealth of information, including the 25 factors affecting business valuation and examples of our 5 senses inspection report. We even have redacted versions of inspection reports for you to see how this process works in real life. The power of proven methodology. Just last week, a franchise owner and their bank, in this case RBC, chose to use the Eric Jordan 25 factors affecting business valuation process in combination with the Eric Jordan 5 senses inspection report. Why? Because it's a process that's recognized and accepted by the Canada Small Business Financing Program, CSBFP. I have a good working relationship with CSBFP's upper management. They often seek my input, and I have the email trail to prove it. This is a regular occurrence for me, and next week it'll be another client and another bank, but the process will remain the same. The difference between accountants and business valuators. Here's where it gets interesting. We start where accountants leave off. Accountants are trained to reduce your tax burden, and that's great for taxes. But tax value is not fair market value. In a real business valuation, especially for private companies, we have to focus on fair market value as required under the Canada Income Tax Act. And guess what? The Act demands that intangible assets be valued. You'll find a link to this information on my website, pin.ca. So we begin with the balance sheet. Is everything on that sheet valued at today's fair market value? Almost always. The answer is no. But that's where we come in. Sometimes we have to do an asset valuation, which you'll see under the restructuring and asset valuation section of my website. CPPAs like myself are qualified to do this. And guess what? Most accounting-based valuators are not. I'm qualified to value intangible assets with a proven methodology. Venture capitalists understand intangible assets, but most accountants do not. This is a big part of the problem. Accountants stick to old smoke and mirrors methods. I've written extensively about this on the Business Valuation Fraud and Flaws to Avoid section of my website. Check it out if you're curious. Normalizing the balance sheet. When we normalize the balance sheet, we're identifying what capital needs to stay in the company and what's considered redundant capital. The capital that stays is called the capital cost, and it's charged as a cost on the profit and loss statement. This gives us a much clearer picture of the company's true earnings. Next, we normalize the profit and loss statement. Here's what that means. We make sure everything is paid at fair market value, including the wages of the owner and their family. Sometimes owners overpay themselves, sometimes they underpay themselves. It's our job to get it right. This is where 10 plus years of hands-on business experience comes into play. You'll see why this experience is crucial compared to a 20-year accountant with no operational experience. Why experience matters. If you're flying on a commercial airline, who do you want in the cockpit? The captain with 10 years of hands-on flying experience, or someone who's only ever sat in a classroom? When you're in surgery, who do you want leading the operation? The head surgeon with 10 years of operating room experience, or someone who's only read about surgery? And if you have $1 million family heirloom in need of restoration, who do you want doing the work? An art restoration specialist with 10 years of hands-on experience, or someone with a textbook education? Your family's private business deserves the same level of care. You deserve a valuator with hands-on operational experience. This disqualifies most accounting-based valuators. Smoke and mirrors, free cash flow, and EBITDA. Now let's talk about smoke and mirrors. The term free cash flow to the owner is used by some to mislead people. It's not profit. It's a tactic used by scoundrels to make you think you're seeing profit, but in reality, the business might be losing money if fair market wages were being paid to the owner. If you're buying a business for $500,000, wouldn't you want to know what percentage of that $500,000 is coming back to you each year as profit after paying fair market wages, taxes, and expenses? That's the real return on investment, ROI. Then there's EBITDA, earnings before interest, taxes, depreciation, and amortization. It's fine for public companies, but it's completely inappropriate for private businesses. Unfortunately, scoundrels use it to inflate perceived profits. Not everyone using EBITDA is a scoundrel. Some people are just ignorant and stay that way because it's convenient. But remember this, you're buying a private business, not a public one. And you're entitled to a valuation that reflects the real picture. Who's best qualified to be a business valuator? This brings us full circle. Who would you choose to do your valuation? Someone with 10 years of hands-on experience owning and operating a successful COBS Bread franchise or similar business, or an accountant with 20 years of back office work? I'll leave you with this. If you're looking for a valuation that recognizes the true value of your business, particularly your intangible assets, then you need someone who's done more than crunch numbers. You need someone who's run the show. That's what the Eric Jordan 25 Factors Affecting Business Valuation methodology is all about. Visit our website for more insights and to see redacted examples of our 5 senses inspection reports. Saskatoon business examples. 7 Shifts. Founded in 2014 by Jordan Bush, 7 Shifts is a restaurant team management platform that streamlines scheduling, payroll, and communication for the hospitality industry. Bush developed the idea after observing the scheduling challenges in his father's restaurant. The company has secured over $150 million CAD through various funding rounds, including a $21.5 million Series B round in May 2021, led by Enlightened Hospitality Investments, and an $80 million Series C round in February 2022, led by SoftBank Vision Fund 2. Vendasta, established in 2008, Vendasta provides a platform that assists small and medium-sized businesses in adopting digital solutions, offering tools for marketing, sales, and customer management. The company has experienced significant growth with a notable funding achievement in 2021 when it secured $119.5 million to further expand its operations. Coconut Software, founded by Catherine Renier in 2011, Coconut Software offers appointment scheduling solutions tailored for the financial services sector. Renier started the company to address inefficiencies in client scheduling within banks and credit unions. In 2021, Coconut Software raised $28 million in funding to enhance its platform and expand its market reach. Skip the Dishes, launched in 2012 by brothers Josh and Chris Semer. Skip the Dishes is an online food delivery service that connects users with local restaurants. The idea stemmed from the founders' desire to create a more efficient food delivery network. In 2016, the company was acquired by UK-based Just Eat for $110 million, facilitating further expansion across Canada. Salon Scale, founded by Alicia Solier in 2018. Salon Scale provides a digital solution for salons to manage and track hair color usage, helping to optimize costs and reduce waste. Solier, a salon owner herself, identified the need for better inventory management in the industry. The startup has received support from local tech incubators and funding programs, contributing to its growth in the beauty tech sector. Safety Tech. Established in 2014 by Craig Fraser and Patrick Robinson, Safety Tech offers a platform that digitizes safety programs for construction companies, aiming to improve compliance and reduce workplace incidents. The founders leveraged their backgrounds in construction and technology to develop the solution. Safety Tech has participated in various accelerator programs and secured funding from investors focused on construction technology innovations. Co.Labs. Launched in 2017, Co.Labs is Saskatchewan's first technology incubator, supporting early-stage tech startups through mentorship, resources, and networking opportunities. While not a traditional business, Co.Labs has been instrumental in fostering the growth of numerous intangible asset-heavy startups in Saskatoon. It has received funding from both government sources and private sector partnerships to support its initiatives. Before I sign off, I want to give a shout out to COBS Bread. I've done valuations for many franchises, and COBS Bread stands out. Their support for franchisees in purchasing supplies and marketing is second to none. Their contributions more than justify their franchise fees. Congratulations, COBS, for setting a new standard. If you're looking to understand the true value of your business, I'm here to help. We'll recognize your intangible assets and maximize your business valuation. Thanks for listening. This is Eric Jordan, CPPA. See you on the next episode.
Vin.ca